So right now, the Bitcoin market is basically a war zone. We saw that big, sharp pullback, and now prices are trying to climb back up. But here's the thing. The experts are completely split. Are we looking at the start of the next massive rally, or is this whole thing just a trap before an even bigger crash? And that is the million-dollar question, isn't it? A rebound or a trap? You've got one camp saying, no, this is real, the recovery is happening. And then you have the other side shaking their heads, convinced this is a classic setup for a much, much deeper fall. We're talking about two totally opposite futures here. And believe me, both sides think they're 100% right. All right, let's start with the optimists, the bulls. Their case is that this isn't just a blip. It's the real deal, the beginning of a sustained climb. And, funny enough, they think all the negativity and fear swirling around right now is actually the best proof they could ask for. Okay, so their whole argument really revolves around this classic piece of market slang, the dead cat bounce. Yeah, I know, it's a pretty grim picture, but the idea is that if something falls far and fast enough, it'll bounce a little, even if it's, well, In the market, it means a temporary price jump that's absolutely doomed to fail, and a lot of people are yelling that that's what's happening right now. But here comes market analyst Peter Anthony, and he is pushing back hard on this idea. He thinks calling this a dead cat bounce is a huge mistake, one that's driven entirely by fear. In his view, that very pessimism is what's going to pour gasoline on the fire for the next rally. And his take on this is just perfect. He says traders are so shaken up from the last drop that they're just going to keep screaming dead cat bounce at every little move up, staying on the sidelines until Bitcoin is screaming past $100,000 and it's way, way too late. And you see, this skepticism, it feeds into this really predictable emotional cycle. Anthony lays it out beautifully. It starts with fear. People panic sell near the bottom. Then, as the price starts to recover, they're in a state of disbelief. They're saying, nah, can't be real, it's a trap. But as it keeps going up, that disbelief morphs into FOMO, the fear of missing out. And that's when they finally give in. They buy, but they end up scrambling back in at a much higher price than where they sold. So what's the big finale for the bulls? Well, Anthony's got a number in his sights, $115,000. He believes that's the magic number. That's the price point where all that disbelief finally shatters, and it unleashes a huge wave of FOMO that just sends prices into the stratosphere. But hold on, that's just one side of the story. Now we've got to flip the coin and look at the bear case. And this perspective, it couldn't be more different. It ignores all the psychology and focuses on one thing. Cold, hard data. See, the bears are asking a pretty simple question. What if all this talk about fear and greed and FOMO is just noise? What if there's a huge historical warning sign flashing bright red that we just can't afford to ignore? And the tool they're all looking at is this, the 50-week moving average. Just think of it like a massive line in the sand for the long-term trend. If the price is above it, things generally look pretty good. But when it falls below, that's when the alarm bells start going off. And guess what? That is exactly what just happened. Analyst Tony Severino points out that Bitcoin has officially broken and closed below this critical line for the first time in this whole cycle. And if you look at history, this is not a small thing. Now, here's the really chilling part. In the last 3 bear markets, what happened after Bitcoin broke this line? Well, on average, it dropped another 62%. Historically, this technical break has been the signal that a much more painful, prolonged downturn is just getting started. So this just lays the conflict out in black and white. You've got the bulls looking at psychology, targeting over $115,000, and then you have the bears looking at the charts, seeing a potential drop all the way down to $38,000. I mean, you literally cannot get 2 more different predictions. So how on earth do you make sense of these 2 extremes? Well, that brings us to the real state of play right now. Total analyst uncertainty. Even the pros, the people who do this for a living, are finding it really hard to call what's coming next. I mean, just take a look at Tom Lee from BitMine. This guy is one of the biggest, most well-known Bitcoin bulls on Wall Street. He's been super confident all year, but lately, even he's starting to sound a lot more cautious. And you can see the change right here. It's pretty dramatic. His first really bold prediction was for $250,000 by 2025. Now, his revised outlook is, well, maybe a new all-time high. I mean, that's a gigantic shift in conviction. So what's behind all this hesitation?
Well, it boils down to this fascinating idea from Lee himself. He says that pretty much all of Bitcoin's gains for an entire year happen in a tiny, totally unpredictable window of time, usually just 10 days.
And the numbers? They're just mind-blowing. In 2024, if you were invested for just those 10 best days, you'd be up 52%. Great. But if you missed those 10 days, you'd actually be down 15% for the year. Think about that. Missing just a handful of days means you miss out on all the gains.
Okay, so after all that, where are we? We've got the bull case driven by psychology, the bear case driven by data, and this crazy reality of extreme volatility. How do you find the actual signal in all of this noise?
You know, what this really is a clash of worldviews. The bulls are making a bet on human emotion, on fear and greed. The bears are making a bet on historical patterns and cold, hard data. And that volatility factor is just this constant reminder that trying to time this market perfectly is a fool's game, because the days that matter most pop up out of nowhere. So, at the end of the day, when the experts are hedging their bets and the charts are pointing in completely opposite directions, there is only one thing you can actually count on: volatility. That is the name of the game. Which really leaves us with one final big question. When one expert sees a rocket ship and another sees a cliff, and both of them have good arguments, the real challenge isn't just about picking a side. It's about figuring out your own process for navigating this kind of conflicting information. Thanks for joining this explainer.